In this video, we'll continue where we left off. So we did the first 6 entries from January 1 to January 10th. And so now we'll continue with January 12th. So ABC purchased 12 months of insurance. I'd assume January 1 to December 31st. Even though they purchased it on January 12th, we're going to assume that it was purchased for January 1 to December 31st, right? For $12,000. Okay, so what's happening here? What are we receiving? What are we giving? Well, in this case, we're receiving insurance paid ahead of time, and that account is prepaid insurance, and we're giving cash, right? So we're going to assume that this purchase was made with cash. So again, we look at the scenario, and we have cash is going down, so you credit, and then prepaid insurance and an asset is going up, so you debit. All right, and it's the same process over and over again, and the amounts for that is $12,000. So I'm going to put in 12,000 here and another 12,000 here. And then of course, what do? I go down to my T accounts. Here's my credit for 12,000 and here's my debit for 12,000 on prepaid side. So you've got to post the entries every single time. All right, let's look at the next one. So the next one is the 13th. ABC prepaid 6 months worth of rent. Assume January 1st to January 30th. So again, this is not insurance. This is prepaid rent. So when you prepay rent, that is the prepaid rent account. We're going to assume this was cash. So you're paying cash of $24,000. You're receiving prepaid rent. And if you look at the journal entry handout, cash is an asset. It's going down, so I credit it. Cash, asset. Anytime you decrease one of these assets, you credit it, except if it's a contra. Cash is going down. Prepaid rent is an asset too. It's going up, so I debit. So I'm going to debit the prepaid rent, and I'm going to credit cash. So I'll put that in here, and it's going to be 24,000, 24,000. Okay, ABC purchased supplies with cash. Again, a very similar entry. What am I receiving? I'm receiving supplies, which equal $21,000, right? So supplies for 21,000. And what am I giving? I'm giving cash. So cash is going down, supplies is going up. All right, so again, cash is an asset. When it's going down, I credit the asset. And supplies is going up. Supplies is an asset. What do? I debit the asset. So debit supplies, credit cash for $21,000. So I'm going to go in and I'm going to write my journal entry just like this. And I'm going to put in 21,000, 21,000. And I'm going to come down again and I'm going to record it to my general journal. Here's my debit for $21,000 with the date. And up here, here's my cash credit for $21,000 with the date. All right, we got to post the journal entry. Okay, the next one is the 16th. So it says ABC received money from a customer for work to be performed next month. So here I received money. So if I'm receiving money, that is cash. And right away, I can do the shortcut, right? If I'm receiving money, that's cash. Cash is an asset, it's going up, so I'm going to debit cash. If there's only one other account, whatever that account is, it has to be a credit. Okay, so that makes it very easy to figure out the journal entry. So we'll do the cash part first because we know that. We're going to debit cash. Why am I receiving this cash? Okay, you receive money from a customer for work to be performed next month. It didn't say you perform services. If it said perform services, that would be service revenue. It says it's work you're going to perform in the future, and we have an account for that work that you will perform in the future after receiving money is called unearned revenue. Unearned revenue. So that is the account. Our account is unearned revenue, and that is a liability, and so we credit that. And even if you didn't know the rules, for example, unearned revenue is going up. Unearned revenue is a liability, so it's a credit. Even if you didn't know the credit rules, you debited cash, so the other account has to be a credit. Okay, and so what's the amount for unearned revenue? $180,000. So I'm going to put it in 180,000 here. And 180,000 here. And then I go down first to cash. Here's my debit for 180,000. And then I'm going to go to unearned revenue, which is a liability. And here is my unearned revenue account, a credit for 180,000. All right, so it's just repeating the same steps over and over. You do the journal entry and then you go post it to the ledger. All right, let's look at the 19th. ABC's sales department was cleaned by a cleaning company, Super Cleaners. After cleaning, Super Cleaners left a bill. So ABC received cleaning services. Whenever a company receives services, that's an expense, right? So we receive cleaning services and they didn't pay for it, they're going to pay later. Whenever you receive something, you're going to pay later, that's a payable. So we've got an expense and a payable. So what's happening, right? You owe more money now than you owed before. So your accounts payable is going up. Accounts payable is a liability, so we're going to credit accounts payable, right? Because it's increasing. They did work for us. They left us a bill, so now we owe money. So our accounts payable, if it was zero before, now it's the amount that we owe, okay? And now we also have expenses because we receive cleaning services, so we have cleaning expense, even though it's not listed on here. Again, for expense, you could call anything an expense. You could have painting expense, cleaning expense, cooking expense, washing expense. You just put the expense and any name in front of the expense account, and that's the kind of expense it is. So we can't list every single expense that we have. In this case, we have cleaning expense, right? So cleaning expense, the expense is going up, that's a debit. Whenever you receive services, that increases the expense account. Whenever somebody does work for you, you hire someone, you employ people to do work for you, that's an expense, okay? So we have the debit to cleaning expense, the credit to accounts payable, and the amount is $1,000. So I'm going to put in 1,000 here and 1,000 here. All right, the next one. ABC purchased office supplies on account for $1,200. So what am I receiving? I'm receiving supplies. That's an asset, okay? Supplies is an asset and it's on account. On account just means on credit. It means there's no money that was exchanged. And what account is that? That's going to be accounts payable. Accounts payable is also going up. When you buy something on credit, you now owe money, which is your payable increases, which is a credit to the payable, and debit to the asset that we receive, which is cash. So I'm going to debit supplies, and supplies and office supplies are the same thing. So, I'm going to debit office supplies, and I'm going to credit cash, and not cash, sorry, accounts payable for $1,200. So I'm going to put 1,200 here, 1,200 here. So I'm going to go down to office supplies, and here's my 1,200 on the debit side. Now I have it automatically linked to set it up like that, but you're going to have to type it in. So I put in the 1,200, and then I'm going to go to my accounts payable account, and then here is my 1,200. All right, so we'll stop here. That's the other 6 entries, and I will start another video for the remaining, for the next set of entries.